Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Bryan Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Bryan are here to help you focus on what matters most in your life, living well.
Hello, everyone, and welcome back to the J.L. Smith Holistic Wealth and Health Podcast. I am excited today. It's a timely topic. We're here to talk about market volatility, right? And with the changes going on with the world, the changes going on with the government, it's a good time to talk about this. So I brought in a colleague, a good friend of mine, Seth Meisler. He is a financial advisor and a chief investment officer with decades plus of experience. He has strategic financial planning, tax planning, and investment management. He holds a charter financial analyst, certified financial planner, and certified public accountant designations, along with an MBA from DePaul University and a BBA from the University of Michigan. Boo, Michigan. Go Ohio State. He is passionate about simplifying complex financial matters. Seth is an active member of professional organizations, contributes to financial publications, and serves on the board of the 6 Points Theater. Seth, with all joking aside about the Michigan, very glad you're here to talk about market volatility today.
Thank you, Bryan. You should be pleased. Ohio State did win the national championship.
So. I think it's a win-win for us this year because you beat Ohio State, but we still won the national championship. If there's any universe that Michigan and Ohio State's happy in football, it's probably this year, right?
Exactly.
No doubt about it. But we're getting a lot of phone calls, people reaching out about market volatility. What should they do? What's going on? So, Seth, I want you here because you're the expert of this. And the first question you're probably getting is, should I adjust my investment strategy to manage for this market volatility? Or what should I be doing? Help kind of resolve some of our anxieties here.
Yeah, I'm sure like you and many other advisors, we're starting to get phone calls from clients concerned about markets. And we like market volatility when markets go up, but we don't like market volatility on the other direction. And I always say that markets don't like uncertainty. And so when there's uncertainty in the markets, that's where people then, both companies start pausing. They don't know where things are going to go. So they may hold off on hiring or they may hold off on investment decisions. And individuals as investors are concerned about where markets are going and may choose to exit, leading to a drop in prices, at least temporarily. And so that level of uncertainty is what I think is causing markets to fluctuate quite a bit so far this year. We have tariffs today, no tariffs.
Percentage of tariffs, we just don't know, right? There is a lot of uncertainty in the market. And you said it best, is like, what are companies going to do? Do they invest at this time? Should they be buying, should the car maker should be making more cars? We don't necessarily know that. And what I'm hearing you say is, we need to manage this with knowing there's uncertainty at this current period. But again, should I go jump ship? Should I make a major change? What would you say, Seth?
No, I think that in my mind, the long-term story for stocks and for markets, it has not substantially changed since January 20th. In other words, companies are still profitable. They're still growing. There's a huge investment going on in companies, in technology, particularly in AI improvements. I think it's going to be a radical change in productivity. We still have population growth overall and in the United States, and companies generally find a way to make things work, regardless of what administration is there, what laws are there. They are very efficient at figuring things out. Overall, again, the broad market, yes, there are winners and losers all the time, but the broad marketplace generally tends to figure things out. And so I think the positive case for stock markets over the long term is still intact.
Yeah, that's a great, very high level view. And to your point is overall the general markets are efficient and they will perform. And sticking to the strategy is always important, right? We create financial plans for people, financial bucket plans, and following those is so crucial. But during these times of high volatility, I don't know, it feels like I see more gold commercials on TV and those kind of things, right? But is there certain asset classes that perform better, like bonds, gold, defensive stocks, that might be, more stability during these times? Should I jump to those? I don't think so. But is there something there that's going to perform better during these times?
I think the hard part is we have been seeing a rotation in the marketplace recently. So, for example, in the last couple of years in particular, but even longer, I don't know, 15 years or so, technology, for example, and US also have trounced other areas. In other words, the US has trounced international stock performance for, I don't know, 15 years. I mean, and by big percentages. And right now we're seeing international stocks outperform US stocks currently. Again, 2 months is almost like meaningless. And same with technology stocks. We've seen it taking a breather, and we've seen value or small caps. We've seen a little bit of a rotation recently. I think it's too early and too hard to say whether that's a permanent state of affairs or whether it would rotate back out. I wouldn't be surprised personally that this is really a short-term rotation, and then it flips. In other words, US kind of reasserts itself. So I think, two things come to mind for me, and I'm certainly interested in your opinion as well, but it just shows the reason why we're diversified, because nobody knows what any specific sector or area is going to do in the market, and why it pays to have a long view and not run to one thing and then get whipsawed that technology now reverses itself and starts going up versus other sectors a month from now or something like that.
Yeah, I'll give you a little bit of my perspective in the game here. Is we've had 2 incredible years, right? If we look at 2023 and 2024, we saw 20+% returns in both those years. That's awesome. Historically speaking, the third year, the one after those 2 great years, the market doesn't do as good. And what I mean by this, probably not another 20% return, but historically it does still like 12 to 14% rate of return in that third year. That's that historical standpoint. But also we had an election, we had a change of the politicians that are in office currently. So that changes things. I do believe currently, we're still within that first 90 days of presidency. I mean, with the news, it feels like it's been so much because you see a new news headline of this or that, and it's emotional, right? During these times, the market goes down because people actually leave the markets or sell their investments because they're making some sort of emotional decision thinking, hey, this tariff or what's going on right now could greatly, greatly change the market. So I still think more than likely we're still going to have a reasonable return here in 2025. It's hard to tell if some radical policies come through. That could change things. But if we keep the current business tax rates or even potentially lower them from where they're at, as we know, Seth, that's favorable for the markets. Currently, we're running against December 31st of this year that the current tax code is going to sunset for individuals like us. If we get some renewance of that, that could be very beneficial to the stock market also, because people will have the security of knowing, hey, I'm not going to pay more in taxes in the future, at least the next future years. Maybe I can reinvest some of those dollars as I've been doing over the last few years. So that's really a lot of my thoughts and philosophies. But Seth, how can we stay disciplined during times like this, right? We're all human beings. We all have emotions. how do we avoid making those emotional decisions during market downturns?
I go back to 2009, that 2007, 2009 period of time. And that to me was probably the scariest time in my professional career, having not been around during the Depression. But, something I hope that I never have to relive again, the 2007 to 2009 period when the stock market dropped about 50%. And I remember that what I had to do is I didn't open my statements. Like, in other words, the best thing I could do is just not look, and that way not think about it. And in some respects, sometimes it's the noise, it's the media, it's the kind of bring this up. I mean, even though we're talking about volatility, the truth of the matter is, in the scheme of things, the move hasn't been significant yet. I mean, every year we have, I don't know, an 8 to 10% drop, an intra-year drop in the market. We're nowhere near that right now. Wouldn't you agree?
No, I would agree. And actually, it's a little bit higher than that. It's usually like 10 to 13%. And I think right now, if we take the high of the S&P recently, when we're down, like, as of recording this video, 6%. Don't worry. By the time you listen to this, it's probably either down a little bit more or has recovered, right? But the whole point here is having the financial plan and sticking to the financial plan. That's why you have a now, soon, and later bucket. That soon bucket is providing us with 10 plus years worth of income. So more than likely, if we have the financial plan in place, you shouldn't be affected by the markets of the income that's coming in on a monthly basis. So it generally shouldn't be changing your lifestyle, right? And a lot of the money that's more geared towards the longer term, that's the money that's taking in these temporary losses. And I think that's the biggest thing. Words matter, Seth, and we know that. And thinking it through and saying, hey, temporary losses or paper losses. The only way you incur these losses if you sell, right? And if we go back into August of 2024, I think within a week, the market went down like 11%. Like all of a sudden, boom, we hit a huge one. October of 2023, the market was down like 12 to 14%. So to Seth's point here is like there are always going to be inter-year market corrections, and sticking to your principles and your financial plan is so crucial. And, I was talking with some other advisors today, Seth, and it's this thing is, if we do see a larger correction, it's actually an opportunity. Any bigger correction is an opportunity to either rebalance your portfolio, maybe you sell some of your more conservative investments and buy into the market, or we start doing some Roth conversions during that time frame where you're converting the shares over at a lower valuation. And when the market comes back, a great example is that year 2020, COVID happened. And Seth, how much uncertainty was in the world at that time, right? No one knew in March of 2020 what was going to happen next with COVID. And the market in that month, from February to the bottom of March, was down 33%. We were on the phones, as you were too, as just calling people saying, hey, let's convert some money to the Roth right now. We don't know what's next. But if the market does recover and we get ahead of this COVID thing, what could end up happening is we convert those shares over, and when it comes back inside your Roth account and grows tax-free. So again, I think the main thing is managing emotions. And Seth, I joke all the time is while we're financial advisors, sometimes we're also, therapists, and we're helping people with behavioral investing, right? Reminding people, stay the course, don't do any emotional reactions, because history shows, and whether it be financial or anything in life, when you make an emotional split decision, it's usually not a good decision, and we're not thinking it through thoroughly.
Yeah, I think back to the bucket plan and sequence of return risk that we spent a lot of time teaching people. Why do we have the now soon bucket is because of sequence of return risk. And this is what it looks like to some extent. And why we always try to make sure that we have a place to get money from when you need to get money. And it's a big focus of what we do and why we do what we do, the philosophy of J.L. Smith. And that should provide comfort that it provides time. Time is on your side for markets to recover.
Yeah, I love it. And Seth, I came to see you, and you've built out my financial plan. How have you incorporated market volatility in my financial plan or my retirement projections, whether it be a Monte Carlo, those kind of things? And I know that you do that all the time, but let people hear that again. It's like going to church. We got to continue to hear the message here. So what are you doing to incorporate that market volatility into my financial or retirement projection?
So certainly that's exactly right. So we're assuming as part of the financial plan that we're putting together situations running what we call Monte Carlo, but simulations that determine market volatility, that because we don't know, markets are going to go up, markets are going to go down. And so that's factored in to see that the plan works based upon the current withdrawal rates. That's one thing that we do. The other thing is breaking up the asset allocation by that now, soon, later buckets so that we're limiting that volatility. We know that there's going to be market volatility. We know that it takes time to recover in the marketplace. And one thing I think that's really important is the market volatility doesn't change all that much year to year. In other words, the riskiness of the market today is going to be the riskiness of the market tomorrow, is going to be the riskiness of the market like a year from now. The risk is risk. And risk of market volatility doesn't decrease as the longer you're holding an asset. It's really the reason we have that later bucket is because it provides the time for recovery if there is a market dislocation. That's the secret sauce. In other words, it's really allowing it to, if there is a market drop, that you have time to recover. And that's why the now bucket is in cash, or not cash, or cash like money market, et cetera, is because if there is a drop in the market and you need to get that cash, you know where it's going to come from, and it's not going to drop in value. In fact, it's going to go up. So that's one thing I think that's really important.
Now, I think there's a lot. There's an importance there, and I want to go over the time frame called the lost decade, from the year 2000 to 2009. Right? We consider that the lost decade. We had the tech bubble where the market went down 40+%. And Seth, you talked about the great financial crisis we all lived through, and that market was down 50%. And we've greatly recovered from there. But when we build out these financial plans and these projections for you, incorporated in there is using some data from that lost decade to prove, like, hey, is your financial plan, if we go over the worst stock market that we've seen since 1930, we look and we use that the year 2000 2009, are you still going to be all right? We're using those projections. We're using that data to simulate all of your individualized financial plans to make sure that, hey, guess what? You're still on course. If, God forbid, the market took a 30% hit tomorrow, is it going to suck? Yes. No one's going to like it. I'm not going to like it. Seth's not going to like it. No client is going to like to see their portfolio go down 30%. But at the end of the day, we've prepared for this. We're ready for this. That's the big takeaway here, is when you see this market volatility, we're at 6%. Yes, for a lot of us, that's tens of thousands, if not hundreds of thousands of dollars. I get it. Believe me. We're all in the same boat together. We want these assets to grow as much. But the main thing is we've planned for the worst case scenarios. Not saying it's going to happen by any means, but we've planned for this. And that's why, hey, this market volatility is part of the game. And it comes to this other question, Seth, is why the heck do we even take on this market volatility, right? What is the purpose of it?
Yes, I think that's a really fair question. Because of the fact that, right, we take it on because of returns. In other words, we accept the market volatility in order to get a higher level of return. That doesn't mean that everybody should take on that market volatility, or everyone wants to take on that market volatility. I mean, we're in a fortunate situation, which is way different than it has been for, 10 plus years, that you actually can get a return on bonds. That wasn't the case not that long ago. And so for some people, if we don't want to have a situation where you can't sleep at night, it's keeping you up. And that's not what we want. We want people to have the confidence or have the comfort that they know where they can get money from and that they're going to be okay. If you're too stressed out, number one, we want to try and plan that in advance so you're not stressed out like after the market has dropped. But there are places to still get a reasonable rate of return in fixed income. So one other thing I do want to ask, Bryan, I'm sure you get this as well. Like, I heard from Joe Schmo at Joe Schmo Company, and they've said that we're going to have, due to, high tariffs, high taxes, whatever is going on of the concern of the day. And therefore, for that reason, we're going to have higher interest rates or lower interest rates or a 35% drop in the market. How have you responded to that? What do you think when, Joe Schmo comes out and says those things?
Yeah, so I love this philosophical saying, and it's a broken clock is always right twice a day. And I say that, and it's so important because when you think about it, is these people have existed and they've always existed, right? And they're going to take whatever the headline is, and they're going to come around and go, hey, this is the next thing that's going to crash the market 30%. They have this in year, and every year it continues to happen. I could name probably 5 or 6 people that I would refer to as doomsayers. There are these big wigs out there that are on the TV or on the media, but if it bleeds, it leads, right? And that's an old saying with headlines. Like, it has to be a headline that grabs your attention to make you read it. And the more gruesome or the more brutal the headline is, the chances are, as human beings, we're emotional, we're going to click on that. So these people are always going to say, this is going to bring the market down, this is going to bring the market down. They have something every month, every quarter, annually that they come up with why the market is going to end up going down. And guess what? Are they eventually going to be right? Exactly. And they're going to tell you, I told you so. However, how long is that going to take? Let's just say you stayed out of the market since COVID hit. How much are we up over that time frame, right? If we just go to right before COVID hit to where we are at today, if you would have just went on the sidelines and say, hey, I'm going to put it into a money market account that paid 0% for 2 years and now is probably paying 4%, what did the market do over that time? And it is a huge, huge difference. So those doomsayers, as I refer to them as, are telling you, get out, do these kind of things, great. But typically they're trying to sell you a financial product. There's some sort of vested interest behind that. But I go to that saying, Seth, all the time, and it was a great question, is, a broken clock is right twice a day, and history and time is on our side. Look at how the market has done over time. Go out 100 years, go out 20 years. And yes, there's some bounces down over that time frame, but it still ticks up and to the right? Up and to the right, saying it's gone up over time.
Yeah, I agree. I mean, the longer I do this, the more humble I am about thoughts on the marketplace and realize that no one knows anything. And we saw that a couple of years ago, right? 95% of economists predicted that we were going to have a recession. Recently, everyone has been saying that interest rates are going up. That's what I've been hearing. Over the last month or longer, interest rates have been going down. So again, you hear this from the expert, from I'll put in quotation marks, the experts.
Yeah.
And I think it seems the experts are more wrong than right.
Yeah. And I think the real expert is time, right? And they say time heals all, and over time, you'll see the decisions. Look at the market over a time frame. And that's why we have that now soon bucket to cover shorter time frames when you need cash to live off of. And we have the later bucket so you can stay invested in the market. It's time in the market that realizes the returns. And this is kind of how we got in the question. And I want to talk about the 10-year Treasury yield right now. Is the 10-year Treasury yield sitting at like 4.25? And we take on this market volatility to beat that 10-year Treasury yield. If we look over the last 10 years, which granted, I know that's subjective, and it's been a very, very good rate of return. But if you just said in the Treasury, let's say it was at 4% 10 years ago and stayed that way, just for this illustration we're talking about, did we outperform the Treasury, right? That's why you're willing to accept on that volatility. And maybe if you're in a 60-40 portfolio or you're 100% stocks in your portfolio, your goal is to beat that. And even if you get 5.5 or 6% because you're more conservative in your portfolio, does 1 or 1.5% make a difference? It makes a huge difference, especially over time, right? That compounding of an extra 1 or 2% compared to the Treasury yield is astronomical over time. When we say 1% or 2%, like I'm at the grocery store, I got 1% off. What is that? But 1% compounding over time or 2% plus compounding over time makes a huge amount of difference. And depending on your asset size, that could be hundreds of thousands of dollars, if not millions of dollars in the long run.
Right, exactly.
Seth, one kind of last thought here is, should I change the diversity of my portfolio at this time? If I'm 60-40, should I be jumping to a 70-30 or a 50-50? What would you say?
To me, I would say I don't see, based on the current volatility, I don't see an advantage to making a major change in your asset allocation. Your asset allocation is for the long term. And so you really need to think about it over the long term. At the same time, I think, Bryan, you said this earlier about markets. When markets are in sale, that's the time to do things. And of course, right, emotionally, and we're all emotional, we're all human, but the market's one of those few places that if there was a for sale sign, everyone would be running the other direction, right? If the local store had, the clothing store had a 25 or 30% off sale, everyone would be running to buy. When the market has that, everyone's running to sell. And so it's something to really keep in mind that if there was a really large dislocation, objectively, as I said, we're all human. So objectively, I would say, yes, it's definitely an opportunity to think about buying. It's really hard to do emotionally to say, okay, well, now I think it's low enough that, because when do you get in? Most people get in after it's recovered.
Yeah. And, you feel like you just got your teeth kicked in, the market's down 20%, and you have to somehow convince yourself it's time to buy in. And leading up to like 2022, some new people that I had brought on and clients, let's just say in 2020, 2021, I said to them, that we were discussing, should I be in a 60-40, a 70-30, or an 80-20 portfolio? And we said, hey, guess what? Let's go to 60-40 right now. And in the future, if the market takes a hit, we'll jump to a 70-30 or 80-20. So, and now's not the time. And in 2022, the bottom of the market was down over 20%. And at the end of the year, it ended up about 18% down. So I share that context with everyone is like, right now, it's not the time to make any dramatic decisions. We're here to help you. We're here to guide you down this path. Market volatility is a part of the game. It's a part of why you want to achieve better returns over time compared to some sort of fixed asset, like we use the 10-year Treasury yields here. So the bucket plan is in place to survive the storm and make it through. We have a tax plan in place, and if things get more volatile and we suffer some more of those temporary losses, guess what? We're going to be reaching out to you. We're going to come up with a game plan to do a Roth conversion, or we can even reset some basis in some of those non-qualified accounts. All of that great stuff is on the table for us. Seth, I got one final question for you is, if you have one message about market volatility to share with the world, what would it be?
Stay the course.
I love it, Seth. This is a timely one that we want to get out there for market volatility. I appreciate you taking the time out of your busy schedule. Thanks for listening to another episode of the J.L. Smith Holistic Wealth and Health Podcast. We'll talk to you soon.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. J.L. Smith Holistic Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through J.L. Smith Holistic Wealth Management are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including, but not limited to, age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the investment advisor public disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.